Section 3. Saving. Topic 1. A comparison of the features of regular saving accounts, money market accounts, and CDs. Regular saving accounts are easy to withdraw money from. They usually have lower interest rates and monthly limits on how often you can withdraw money. They have low minimum balance requirements and can also have none. They are insured by the FDIC and NCUA for up to $250,000 per depositor per institution. Money market accounts only allow you to withdraw a certain amount of times per month. They have higher interest rates for higher balances. Minimum balance requirements are higher than the ones for regular savings accounts, and you may be fined if your account does not contain the required amount of money. They are insured by the FDIC and NCUA for up to $250,000 per depositor per institution. For certificates of deposit, funds are locked away for a set amount of time, and you will be fined if you withdraw money earlier than that. CDs have the highest interest rates of these three types of saving accounts, and the longer you keep your money in a CD, the higher the interest rate will be. Why do CDs typically pay higher interest rates than regular saving accounts or interest-bearing checking accounts? The bank holds a CD's money for a long time. It also fines users for withdrawing the money earlier than they initially agreed to. These practices ensure that CDs are a reliable source of money that the bank will hold for a long time and can use for its investments. Because CDs are reliable, banks pay higher interest rates on them as an incentive for more customers to invest in CDs. Section 3, Topic 2. Why would an increase in the number of people who want to borrow money result in banks paying higher rates on deposits? If the bank has more customers, it will have more available money, so it will be able to spend more in deposits interest rates. What are some types of market conditions that could result in financial institutions paying lower rates on savings accounts? Demand for deposits being low, the Federal Reserve policy of lowering interest rates to encourage activity in the economy. Section 3, Topic 3. What are some alternatives to mobile payment accounts? Mobile wallets such as Apple Pay, peer-to-peer payment apps such as PayPal, neobanks which are digital-only banks, cryptocurrency wallets, retailer-specific payment apps, or buy now, pay later services. Here's a comparison of the features of mobile payment accounts, cryptocurrency accounts, and checkings or savings accounts. Mobile payment accounts are a convenient way to pay but lack insurance. Cryptocurrency accounts can be used worldwide but have little regulation and market volatility. Checking or savings accounts are stable and secure but lack modern technological features. Why would storing money in a mobile payment account reduce the ability to grow savings? These accounts' interest rates are low to non-existent, and the easy access their user has to them tempts the user to spend more money more often. Section 3, Topic 4. Why do savers typically earn a higher nominal rate of interest when inflation is high? When inflation is high, the value of the money a saver earns on their interest rate decreases, so their bank pays them a higher interest rate to make up for this loss of value. How can inflation reduce the purchasing power of savings over time if the nominal interest rate is lower than the inflation rate? If the nominal interest rate is lower than the inflation rate, the money in your savings account is increasing more slowly than the price of goods and services are increasing, which means that your savings are losing their purchasing power. How do federal I-bonds provide inflation protection for savers? The variable interest rate is adjusted twice a year for inflation, and there is also a fixed rate along with the variable rate. Section 3, Topic 5. What are the areas of financial institution operations that are subject to state and/or federal regulation and supervision? Licensing, capital adequacy, which means having some capital to absorb losses, protecting people from unfair lending practices, limits on the amount of loans a bank can give, interest rate regulation, money laundering prevention, approval for banks' mergers and acquisitions, and cybersecurity requirements. Why is solvency regulation important for financial institutions? Solvency regulation is a set of rules and standards that ensure financial institutions have enough capital to meet their obligations and remain financially stable. This is important because it protects the institution's customers, as well as maintains the functionality of the financial institutions.
Hi, today we'll be diving into the world of financial planning and investment fundamentals. This presentation is designed to help you understand key financial concepts like retirement savings, managing obstacles to saving, and the basics of investing. Okay, so first we'll start with topic number 6. A traditional IRA offers a significant incentive to save for retirement. Contributions are often tax deductible, which can reduce your taxable income in the year you make the contribution. Additionally, the earnings grow on a tax-deferred basis, meaning you don't pay on the gains until you withdraw the money. This provides a double benefit: immediate tax savings and compound growth over time. It's especially beneficial for individuals who expect to be in a lower tax bracket during retirement. A Roth IRA works a bit differently. Here, contributions are made with the after-tax dollars, so there's no immediate tax deduction. However, the big draw is that the earnings grow tax-free, and qualified withdrawals in retirement are also tax-free. This is particularly attractive for those who anticipate being in a higher tax bracket later in life. I'd like to add comparing traditional and Roth IRAs. When choosing between traditional and Roth IRAs, it's important to consider your future and tax situation. Traditional IRAs are tax deductible, providing immediate savings, but withdrawals are taxed in retirement. Roth IRAs, on the other hand, offer no upfront tax break, but allow for free tax withdrawals later. Your decision should depend on whether you expect to be in a lower or high tax bracket during retirement. Now let's start topic number 7 on ESAs, also known as Educational Savings Account. Education Savings Account also offer different benefits. The Coverdell ESAs allow contributions of up to $2,000 per year, can be used for a broad range of educational expenses, including K-12 and college. 5 to 9 plans have a higher contributions limit and cover tuition for both college and K-12 expenses. Both accounts grow tax-free, incentivizing families to save for education costs. Now we'll be talking about the employer retirement plans and health savings accounts. The employee retirement plans with matching contributions are fantastic incentive to save. For every dollar you contribute, your employer might match a portion, effectively giving you free money. Additionally, the plans that use an opt-out approach, where employees are automatically enrolled unless they actively choose to opt out, result in higher participation rates. The health savings accounts, also known as HSAs, are also encouraged savings by allowing pre-tax contribution, tax-free growth, and tax-free withdrawals for qualified medical expenses. Okay, now I'm going to be starting topic number 8, sharing financial goals with a partner, also known as financial transparency in relationships. Sharing financial goals and information with a partner is crucial for a healthy relationship. It ensures both partners are aligned on saving, spending, and investing priorities, reducing misunderstandings, and fostering mutual trust. Poor financial decisions can strain relationships, while good decisions like saving and budgeting build stability. Okay, now I'm going to be starting topic number 9. Overcoming saving obstacles, also known as managing obstacles to saving. External influences like social pressures and social media can challenge saving habits. To combat this, consider automating your savings, which removes the temptation to spend. Breaking down goals into smaller milestones also makes saving more manageable and rewarding. Identifying and avoiding personal spending triggers in another effective strategy. Okay, so risk tolerance in investing. Risk tolerance is shaped by factors like age, financial stability, and experience. Younger investors with a long-term horizon may be comfortable taking risk, while those closer to retirement might prefer safer options. Understanding your risk tolerance helps you choose investments that align with your financial goal and comfort level. Now I'll be talking about the types of investment returns. Investors' even return earn return through interest, dividends, rent, and price changes. Stock, bonds, and real estate offer different levels of return and risk. Speculative investments like cryptocurrencies and are highly volatile and depend on market sentiment. While they can yield high returns, they come with significant risks. Are best used for experienced investors with a high tolerance for risk. Riskier assets like small company stocks offer high potential returns with a greater uncertainty. This is because investors demand a premium for taking more risks. Diversifying your investments across different asset classes can help balance risk and return. Understanding this trade-off is key to building a portfolio that meets your financial goals. Now we'll be talking about speculative investments. Speculative investments are high risk, high reward financial assets. Examples include cryptocurrencies, penny stocks, and venture capital opportunities. These investments often rely heavily on market sentiment for future expectations rather than intrinsic value. While speculative investments have the potential for significant returns, they come with a high likelihood of loss. They're best suited for experienced investors who can afford to lose a portion of their capital. A common strategy is to allocate only a small percentage of your portfolio, say 5 to 10%, to speculative investments while keeping the rest in more stable assets. The key is to do thorough research, understand the risks, and only invest what you're willing to lose.